This is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, April 8th, 2020. This one will be quick because we don't really have, we had about one technical development that I noticed on the equity markets today, and that was the fact we've made a new divergent high here, or extended, I should say, the negative divergence that was in place yesterday on SPY. So basically, we made another run right at that T3 level. Remember, this was a basis for the yesterday's short trade on SPY. We were right at that T3 level, which was laid out back here when the market was bottoming, final target. And so basically we've just tested it again, but made a ever so slightly new high if you really zoom in tight, and you can see that. And so that gave us really not a new divergent high. Well, we did actually, technically speaking, on the RSI, because yesterday in that post for that setup here, I'll flip over to that was originally laid out on this 30-minute chart. Let's go to the 60-minute chart. That's where the trade setup was posted yesterday. And which board? There it is, right here. Alright, so that does extend the divergence here on the PPO right there, and actually gives us now negative divergence on the RSI right there. You can see before the RSI had made a new high, gave us an extreme overbought reading not seen since right here before the whole bear market started, actually. So this is the most overbought we've been throughout the bear market. So that gives us that slightly extended divergent eye there, and as you can see on that 30-minute chart, I had a little trend line here to watch. So now we have an uptrend line as well. Forget about this little wonky candlestick. This is showing after-hour trades. We're really right about where we closed today, and so this long shadow there on the candle, that's not really anything that happened. For some reason, it seems on this and a lot of charting platforms, they'll go right down to, you can see that yellow dashed line. That's yesterday's close right here. Today's open's a blue line, and it usually brings you down to that line for some reason. So again, ignore it. Even if there was technically a print there, it's not where we didn't trade down to that level. And so that's it. So as I said, I did post an update a little bit before the close today, or this afternoon, showing that we've made another run at that level, and saying that once again gives us an objective short entry for anyone that missed it yesterday, or an add-on for anybody that's scaling into a position there on SPY and wanted to add to an existing short. Okay, and as I've already put out an extensive video earlier today, there was a long video covering many trade ideas, commodities, bonds, currencies, precious metals, and even in individual stock. We'll just wrap this video up with the coverage of the one trade here, because I did fire off a few minutes before the close. I wanted to make sure I got something out to just say that I decided to suspend the stops. Once in a while I'll do that, a temporary suspension. They'll be reinstated tomorrow as is, same stop. The stop on the SSG trade, that's the ultra short, 2-time short semiconductor, that is a stop on a daily close below 1170. Yesterday we closed at 1180, so we're okay there. And today we closed at 1116, it looks like, unless this is showing me after hours. Let me make sure. No, it doesn't appear so. So that appears to be the close today. So again, and that's up to everyone in that trade, of course, even if you decided to take it. But I'm going to show you why real quick. So I'll just spend the rest of the video going over the semiconductor sector. First and foremost, this is a leverage ETF. So although we technically we came back, we were back testing the trend line there, the downtrend line, we went below it. But what you want to really look at are the main semiconductor ETFs that do not use leverage, and that would be SOXX. Let's just look at a weekly chart here, and here's the bigger picture and the whole basis for this trade. You have these divergent highs right here. You can see divergent high there, divergent high there, divergent high, with only the RSI right there. So that this was actually both the RSI and PPO, and then a divergent high here. And so you can see so far this is our correction, which really is in line. It happened a little faster, but it's in line with these other two. And this time around, I've spent days and days talking about the differences right now at any other point in history, including the Great Depression. The fundamentals are infinitely worse right now, and yet the market is, I don't believe, reflecting that at the slightest, especially with the recovery we've had. If you look at where we're at now, the basis for sticking with that first and foremost was the fact I showed you the S&P 500 was at right back at that key resistance level, which was that maximum bounce target before. And you know what I skipped over is QQQ. I should mention that QQQ was a little weaker as I expected going forward, and that's also another theme I think we'll see is that this leg, the first leg down in the bear market that we had, and the rally, tech stocks really held up because everyone figured, and to a good extent, as I talked about, they're more immune to the impact of coronavirus than a lot of companies like travel, leisure, airlines, auto industry, service sector, and all that other stuff. But with that being said, the next stage of what's likely to be the recession that we're in now, and people still use the word depression possibly, will be a drop in earnings and a cutback in demand for a lot of luxury items too, including semiconductors. And you can see that tech, you can see where QQQ yesterday rallied up there to that. That was an old trade setup. Let's see the board that I had here. 30-minute chart. Go back here to... Okay, this is the right board I was looking for. Remember QQQ, when those targets were laid out, the bounce targets, QQQ had a lower, it also had a third and final target, and we hit that, and we hit it again, and then went down over 7%, just like SPY, but we rallied back up. Whereas SPY fell shy, QQQ actually took it out, went up to this next resistance around 201 right here. You have a big old gap back there, a lot of reactions on that level, a lot of reactions from above, and the key 50% Fibonacci retracement level, that is from the entire move down from the all-time highs in QQQ to that low there. So a confluence of resistance, and you can see today QQQ didn't even match that high from the other day, where SPY just took it out. Now it's close enough, but it is showing a little underperformance there on the tech-heavy NASDAQ 100. And should it pop up any more, even an intraday pop, that's what you got to look out for, a lot of these intraday pops and then reversals that we've seen lately. If it does happen, you're also going to have then the divergence on QQQ. Technically, you don't have it now because we didn't make at least an equal high or a higher high with the indicators, but you can see they're severely lagging. So any high tomorrow, if we get it, and you don't have to have it on both indexes. In fact, you don't have to have divergence at all to reverse. It just certainly strengthens the case there. So I did want to point that out because I forgot to cover the Qs before. But going back to the semis and just look at the weekly, you can see SOX, it's one of four semiconductor ETFs that I'm familiar with. So we'll look at each of those real quick. And this is the bigger picture here on the weekly chart. We've retraced now we're just over the 50. This is a weekly candle, keep in mind, but I'm going to put up probably one of the most important levels here, that big 200-day exponential moving average, which is also on a weekly chart. It's the 40-week moving average, and then we rallied right into that. We had reactions off it there before, and when you look back in time, here, turn all these lines off for you. When you go back in time, and we're rolling back for years here, you can see during bullish trends, the 200-day, which is again on a weekly chart, a 40-week moving average, does a great job at defining bull and bear trends. And so when you're in a bull market, there it is. When you're in a bear market, right there, which we were in the semis, they dropped over 20% from there. It came in as resistance there, support. We clearly broke it, and this is the first back test of it actually since this whole thing started. So for that reason, among others, again that I'm going over here, I think it's prudent to give that a little more room. We'll see how things happen tomorrow, but my plan right now is, as I stated, to reinstate that stop tomorrow. So that's SOX. We can look at a daily chart. Let's see what I have on the board. Pretty good resistance. Same level. And here's another one there. We popped that level yesterday. You can see a confluence of moving averages. There's your simple 200-day simple moving average right there. We'll turn that one up for you in blue. The red is the 200-day exponential moving average. Remember, there's 5 trading days in a week. That's why. So if you divide 200 by 5, that's where you come up with a 40 period exponential moving average on a weekly chart. And then you also have that 50-day right there as well. So just like the markets, everything I went over today, a confluence of key moving averages, and again, and not as if they're being tested for the second or third time. What look for in a move like this, a lot of traders are going to step in there. I might have a little less convictions that they were going to fail here if we had come up, tested, failed, hit them 2 or 3 times, because the more you tap on a resistance level, the more likely you are to ultimately break through it. But this again is the initial tag from above, and just like my price targets on the trades, I'd say it's that initial tag from, if it's a short trade, the initial tag from above, it usually gives you reaction. If it's a long trade and we're swinging up, let's say 247.77 is one of the price targets, it's that initial tag where you usually have a reaction from. So that's it right there. A lot of moving averages, price resistance, everything else. And the other ones are SXD. That's another, it's just the Spiders S&P 500 semiconductor, not 500, Spiders S&P semiconductor ETF. Tracks a different basket of semis, but the same story. You can see the confluence of moving averages, price resistance right there. This is a daily chart. Go back here to a weekly chart. You can see the same thing, divergences, and a rally back. We parked today right on, see this dash line right here, that is the 50% Fibonacci retracement, and that's measured from the move on the highs. Let me make sure I have it nice and tight there. It might be a hair off, but close enough. Yeah, close enough. And that's where we parked it today at the close, right on the 50% retracement, with the that key 40-week moving average right there as well. And you can see also, doing a great job. When it doesn't do a good job, like any moving average is in a choppy sideways market. 2014, 2015 was full of that. But other than that, when you get in these trending markets, whether it's a bullish trend or a bearish trend, that's where that 40-week does a pretty darn good job of acting as support during uptrends and resistance during downtrends or bear markets. That's 2 of them so far, SOXX and XSD, and then you have SMH. And this is the Van Eck Vector Semiconductor ETF. Same thing, same story. And what you're seeing is price resistance right there. We're a little bit above the price resistance, that line that I have here on this weekly chart at 120.36, but we're right at, you can see, almost exactly closed at that key 40-week moving average. And if I put up the fibs, you'll see something similar. That puts us right there, right a hair above the 50% Fibonacci retracement. And again, it's a weekly chart. Somebody pointed out, by the way, I wasn't aware or wasn't thinking about it. This Friday is Good Friday, so the stock market will be closed. Therefore, our weekly candles are going to be finalized at 4 p.m. on Thursday instead of Friday this week. All right, and there was one more out there. Let me just go flip to a daily time frame here on SMH. Again, you can see the confluence of key moving averages right there. And then, of course, the divergence was extended here and all the way up to this point before it finally played out for the big drop here. You can see, as was that trend line. I hadn't even updated the daily chart here on SMH. Usually track SOXX, that's my go-to one. But these are all worthwhile because, again, it's showing you just different baskets, a different group of semiconductor stocks all in that sector industry with different weightings, but they're going to have very comparable charts. And then you have PSI, Invesco Dynamic Semiconductors portfolio, same confluence of moving averages, same price resistance. You can see right here, it's not just an arbitrary level. You can see 3 major reaction highs, 1, 2, 3, just like the Qs. Remember I showed you recently that QQQ had 3 attempts to break above a comparable level, and this one actually 4 right there, and then it finally got above it, came in, made a perfect back test, which it helps to validate that. You have 1, 2, 3, 4, then 5 reactions, then 6 on the way down. Actually, another one there, we hit it, and now we're testing it from above. So very, very solid resistance level. And of course, where this comes from is I already went through this. I won't do it in this video because it'll take a long time, but I went through the individual holdings of a lot of the these ETFs, a lot of the individual semis, and you see the same thing. A lot of them at or very near some significant resistance levels. And let's look at it on a weekly chart. There it is on the weekly. Same thing. You can see resistance. You can see the divergence at the high and everything else there. And so that's it. Like I said, I won't go through everything else right now because I did that in the video earlier today. So today was just right back to where we started yesterday at that key resistance in the market in the S&P 500, and so therefore nothing's changed in my outlook. In fact, the only thing that's changed is those divergences that I showed you on that 60-minute and 30-minute time frame have grown even larger now, and we do have the divergence on the RSI. So that's still my outlook. Looking for, when you look at this weekly chart here on SPY, still looking for a reversal there, and still maintain, look, anything can happen, but I still think the risk reward is very favorable to short or be short at this level with stops somewhat above. Again, somewhat is relative to where your target is. If you're a believer, as I am, that the SPY will probably come down here and retest these 2015 lows right there in the coming months, possibly weeks. Then you might want a wider stop all the way up here somewhere, let's say around 293. But again, on the official trade, I'm leaving the stop. We're fine there because it didn't even come close to our stop on the official trade today. Stop is a daily close above 279, so we're still, for now, comfortably above that, and that's another reason I decided to just pull it on the semiconductor trade for now. All right, we'll wrap it up here and get this out to you. This has been Randy Finney with Right Side of the Chart. Have a great evening.